Hi, everyone. Tanya Hertz here. We are starting up the second section of our financial planning workshop, and we are talking about today bookkeeping, and we're going to go through the basics of bookkeeping. So I'll go ahead and share my screen here, and we'll dive right into bookkeeping. So we'll start by talking about the main financial statements that every business should have at all times, and those are profit and loss statements, balance sheets, statement of cash flows, and projected versus actual budget. And that's what we're going to be doing as an assignment for this section. So the projected versus actual budget, you do have a little bit of leeway on that budget and how you keep your records of your numbers, but I'll give you a template that you can use here in just a little bit. So what is bookkeeping? We typically use software for bookkeeping, and bookkeeping is the process of helping our business to budget, to prepare, to file for our taxes, to stay organized, to see targets, to hopefully meet those targets, and to ensure that we're meeting all of the government regulations. Many of us will use software like QuickBooks to help us with our bookkeeping and with our accounting. And I highly recommend doing that. You can also hire someone if you are a big enough business. You can outsource that bookkeeping, or you can outsource just small functions of the bookkeeping or filing the taxes at the end of the year. But no matter what, it doesn't excuse you from keeping track of all of the records. No matter what, you still have to do it all. There's no getting out of it. No getting out of it. So let's make sure that you understand the basic reports so that you can know what's going on. And I will say this too, as your business grows, for those of you who are growing your business, make sure that you have, if you have somebody else who's dedicated and working for you, doing your bookkeeping, make sure that person, that you still have plenty of oversight on that person, and that person takes vacations regularly, so that you know what's going on with the funds, and that person isn't the only person who's responsible for your money, because you see this, unfortunately, more often than you would like in the world of business, and people can take advantage. So it's really important that you know what your business has, what your business spends, and that you have some hand in it. Okay, so the basic formula for a profit and loss statement or a balance sheet is sales minus the cost of goods sold. So you often see that as COGS, cost of goods sold, and that gives you your gross profit. So gross profit is how much money you make minus what it costs you to make that money. Then you have to take out your overhead. So your overhead is, and most of us heard this term and understand what it means, but it's the expenses that we have to spend to keep our business going. So those are things like our rent, our utilities, et cetera. And then that gives us our net profit. And a simple balance sheet is essentially your total assets is equal to your total liabilities plus your shareholders' equity. So they all are the same, they balance out. That's why they call it a balance sheet, right? A balance sheet. And we'll there's some examples for you that you can see, but yeah, we'll go through and look at some of those samples for you. So some definitions in financial statements, some other things that you need to understand what they mean. Gross margin. So gross margin is the difference between what you sell and for the cost to deliver what you're selling, right? An operation margin, it's the earnings that you have, and our operating margin rather is the earnings that you have after you take out the cost of goods sold, and also your fixed costs and your variable costs. So and we'll talk about those in a moment here, but fixed costs stay the same no matter how many you produce of a certain good or service, and variable costs go up with each item that you produce. So a fixed cost might be something like rent, where a variable cost might be something like turkey and a turkey sandwich. Make more turkey sandwiches, you spend more money on turkey, but the rent doesn't change, right? So that's fixed versus variable. And I will say this too, for those of you like our sample person who is starting the MEKHOs business and cooking out of her home, things like rent and utilities, those fixed costs are actually, will often be the cost that we pay for our home, right? For using our home, or the portion of the home that we use for our business. We can still deduct those expenses. So that's one of the many benefits of owning a small business. You get to reduce your tax liabilities because you can claim some of those expenses that you use legitimately, both for business and for personal use. All right. So the profit margin, that's calculated by dividing the company's net income by its revenue. And remember, we talked about net income already. What net income is actually, we haven't talked about that yet. Okay. So I thought we did we not? Oh, we did, yeah. So net profit or net income, same thing, right? Oh, so where was I? I'm sorry, I got us off track. So a profit margin is calculated by dividing the company's net income by its revenues. It's shown as a percentage. A higher percentage means the company produces more net income for every dollar of revenue that comes through the door. So difference between revenue and profit. We just need to understand those differences. When somebody says revenue, that basically means how much money you make. Profit is how much money you actually make after you take away all of those expenses, right? EBIT or EBITDA is earnings before interest, taxes, depreciation, and amortization. So EBITDA. One thing I'll say about this, we just need to know what these mean, but we also need to know how they work. So when you're looking at your numbers and you're figuring out how much money you made, you need to understand that when you get to your EBITDA on your financial statement, your earnings before interest, taxes, depreciation, and amortization, it's not the same thing as cash flow. So you need to know also how much cash you have, right? How much cash you have on hand and how much cash you have available, because they're not necessarily the same thing. Because think about this, as a business owner, you might have really unfavorable terms with your suppliers, where they might want where your buyers might want really favorable terms. So you might not be able to, for example, put things on a payment plan, or be able to pay things until after until after you get the cash. You might have to pay immediately for things, but you don't necessarily have that money to pay for something until you actually sell that thing. And so you have to keep track of all of it, right? So that's why all of these are important. So some basic ratios you should know. Current ratio, that's your current assets divided by your current liabilities. Assets are the things that you own. Liabilities are the things that you owe. And this typically in a healthy business should be at about 1.25 to 2 or even higher, right? So we should have a good, healthy assets to liabilities. We should own a lot more than we owe. A quick ratio is just our current assets minus the current inventory divided by our current liabilities. And this should be 1-to-1 or better. Now, days sales outstanding takes our accounts receivable divided by our average daily sales. Book to bill is a way of saying the ratio of our new business divided by the business that we've actually already invoiced. Greater than 1 means that we have an increasing backlog. So we have a backlog of inventory, which is not a good thing, a backlog of business. Inventory turns, when somebody says inventory turns, they're talking about your cost of goods sold divided by your average inventory. We also need to know a few things about bookkeeping. You have to choose the right accounting software. Most of us use QuickBooks, but there are other software that might be better for you. You need to know how to open a bank account and apply for a line of credit or obtain other business financing. Now, it matters which bank you choose because they'll have different rules and regulations and costs associated with them. You want to have, all of you, no matter what kind of business you own, need to have a separate business bank account, and you don't need to be a citizen to have that. You can open a business bank account with an EIN, an ITIN, and we recently did a workshop on that, and I recommend, I'll put that also in with our course materials, the workshop, or you can look it up on YouTube. It was at the Rec Innovation Lab. We did a workshop on starting opening business bank accounts if you weren't a U.S. citizen, using an EIN or an ITIN, which is essentially like a social security number for your business, right? You can apply for business credit cards, set up charts of accounts, track sales with bookkeeping. Now, make sure that you keep everything separate no matter what. All of your business expenses and assets should be separate from your personal, even if you are running a sole proprietorship. You still want to keep your money. Don't want to commingle your funds. You want to keep them separate and clear. You want to deposit all sales into your accounting software and into the business bank account. You want to record your sales by the customer and by specific revenue line items. You want to decide which expenses are cost of goods sold versus general administrative expenses, and you want to know if your costs are fixed or variable. You want to know what goes into the balance sheet versus a profit and loss sheet. You want to run your financials monthly, and it's nice to have a professional. Even though I say you need to know how to do this yourself, you do want to have a professional as well, and you want to figure out how you're going to pay yourself. Your salary, hourly, guaranteed payments, distributions, and remember when I asked in the last lecture if a business that makes $50,000 I said that wrong. If your business makes $50,000 but you don't pay yourself, are you a profitable business? So you're thinking, well, I make $50,000, but you don't take any salary out yourself. The answer to that is no, it's not a profitable business. That business is maybe just breaking even, considering that you make about $50,000 in a year. So it's really important that you keep all of these considerations in mind when you're deciding what to do with your business. So when you're doing your budgeting, that's the first place to start with your finances. And we're going to do a sample budget. In your budget, it's a list of all your monthly or yearly expenses organized by categories. Now, the categories need to make sense to you. And there are some pretty common categories that we use in taxes and in accounting. But like I said, the categories still need to make sense to you, and you need to be able to record them in a way that makes sense to you. And so I give you some samples that you can use to categorize them, but it's really up to you to make sure that you're keeping track of all of your expenses. You can use any budget tool that you like. You can use software, or just use, I gave you guys an Excel sheet that I use, and it's just used to track your business expenses, to plan for your future, to reduce your costs, because when you look at it on paper, it makes it a lot easier to see where you can cut costs. It helps you understand where your break-even point is and break even for the business, for the day, for the week, for the month, and for each unit of food or service or good that you're producing. It helps you to plan to expand, and it helps keep you accountable to your goals. Now, the cash flow is different, remember, than all these other things, because we still need to know how much cash we have on hand. So not unlike your profit and loss statement, your cash flow, it's not just your revenue, it's not just your expenses. It shows you all sources of cash: your sales, your transfers, your borrowed money, the money that you raise, funds that you get from grants, funds that you refunds that you get from purchases. And you need to make sure that you are able to actually operate with the cash that you have on hand. Because sometimes it takes longer to get the money than it does to pay it out. And so whenever you're taking in cash or a merchant sales receipt or something that's actually going into the bank account, we call that cash inflow. And if we're paying out, like a cash check or whatever way you're paying out from your bank, that's That's not a cash inflow. That's a cash outflow. That's a cash outflow. So split recurring from non-recurring spending so that you know your cash burn rate. You know how fast you're going through it so that you don't run out of cash. I've seen so many business models where people come to me and they think they have a great business model, but the problem is that, like I said before, we need to make sure that we actually have, accounts receivable and accounts payable. That's not the same thing as cash flow. We need to make sure that we actually can pay the bills that we need to pay. And this is really hard when you're a new business because you don't always get really favorable credit terms, right? People might want their money from you immediately, but it takes you a while to actually get your money from your clients, right? So a 13-week cash flow forecast is going to help you avoid surprises. Do it now and continue doing it for the rest of your life, the rest of your business. As long as you own a business, you should have a cash flow summary in place. You should know exactly how much cash you have on hand. Always have a second set of eyes on your cash. Like I said, if you have somebody doing your cash, send them on vacation, make sure somebody else is looking at it. The same person who's putting together your cash flow statement should not be the same person who's in charge of your payroll, accounts payable, and reconciliations, because that's how you have unethical dealings. Understanding these cash flow helps you with your business practices. Know how much money you need to get through the next 90 days, always. Banks need these financials to approve loans. So make sure that you keep track of your cash and money that you're getting in accounts receivable. Have reports, have a plan. It will help you to plan for the future and show how you're spending your credit card payments, your investments, your charity, everything, not just not just like, okay, I'm going to look at my bank statement, good enough, right? Make sure that you know the categories where different things are going so that you can see where you can maybe save some money, right? So different types, there's 5 major accountant groups that need to keep track of: your assets, liabilities, equity, income, and expenses. And we'll go through these actually one by one here in just a moment. I'll see you guys in the next lecture.